Will Trump's big, beautiful bill really mean that 90% of people are not going to be paying taxes on their Social Security benefits? Maybe. That's what we're going to be answering today. And I'm going to take you through some real-world case studies in a tax projection software to show you exactly how Social Security benefits will be taxed given different levels of income, so you can see for yourself what will this actually mean for you and your Social Security benefits and other income and how that will be taxed. If you're new here, I'm Elliot Apple, founder and financial planner of Kindness Financial Planning, and I help people make smarter decisions around finances. And today we're going to be taking you through one of them, and that is tax projections. So with that, before we jump into it, let's go through exactly what this new deduction means for people. And it doesn't help that an email went out recently that said basically 90% of people aren't going to be paying taxes on their Social Security benefits. This may be true, but something to keep in mind is this new $6,000 tax deduction that people 65 and older are receiving are not necessarily changing the Social Security program. It's changing our tax code, and it's important to keep in mind that this is a temporary change. It applies for years 2025 through the end of 2028. So this is a temporary increase in your deduction. It's not a permanent piece of the legislation. So keep that in mind as we go through this and for your own tax planning purposes. The other thing I would note here is that there are estimates that this will make Social Security insolvent a year sooner. There are estimates out there that instead of the official report saying 2033, it might move this back to 2032 instead. So we're going from roughly 8 years down to 7 on when that might be insolvent. And that doesn't necessarily mean Social Security benefits are going away at that point, but it does mean that we're kicking the can down the road a little bit further, and that road is getting a little bit shorter for us. So with that, let's jump into the tax projection. First, I want to go through tax year 2025 and the tax projection software just to give you an example of how things stand with the current law and then what happens under the old law. So with this, as you can see here, I've just made some assumptions for this person. This is Susie and Gabe's sample. Let's assume that they have some money in the bank and taxable interest for that year is $2,000 in 2025. They also have dividends because they have a brokerage account and that's paying out regularly of $25,000. I'm just going to assume they're all qualified for purposes of this analysis. They also are collecting a pension, and that's $20,000 per year. And combined, they're both claiming Social Security benefits at $45,000 a year. Now, I should note that they are both over 65 currently. If this example was that they were not 65 yet, they wouldn't necessarily get this extra $6,000 deduction for one of them, which would be $12,000 as a couple. So let's keep going. You can see here their taxable Social Security is not fully taxable. So that's something to keep in mind, that Social Security is never fully taxable. There are situations somewhere between 0 and 85% that it will be taxable. So there were people before that weren't paying any taxes on Social Security benefits. So this law is really not going to help people who are much lower income, and it's not going to help people that are higher income. And I'll get to that in a little bit to show you where these phase outs actually begin and where you fully phase out of that as well. Let's assume that they also needed money from their portfolio. So they're going to recognize some long-term capital gains as they take money from the portfolio. So if we scroll down, we can see their total income for the year is about $135,000. For this year, their standard deduction is going to be $34,700. That is, if you're enjoying this video so far, please click that like button and subscribe to this channel. That tells YouTube other people should watch this video, which helps get this message out to them so they can do better tax planning in their situation. Now back to it. That's comprised of $31,500 as standard deduction, so that was raised with this new bill. You're still getting a bonus deduction, if you will, for being 65 and older of $1,600 per person or $3,200 total. So with that, we're also going to get that new, we'll say bonus deduction of $6,000 per person or $12,000. We have that itemized here. So combined between the $34,700 and the $12,000, we're getting a pretty sizable deduction. You can see that will bring their taxable income down quite a bit to about $88,550, and the total tax that they're paying on that income is just over $1,300. Now, let's make that comparison to if this tax legislation hadn't passed to see what is the impact for Susie and Gabe's sample here with the income that we just went through. So let's scroll back to the top here. And we can see that I've copied everything over. So taxable interest remains the same, qualified dividends, same pension, same Social Security, same taxable amount of Social Security, because keep in mind, this isn't changing what percentage of Social Security benefits are taxable. It's just giving that extra $6,000, and it doesn't really matter if you're claiming Social Security benefits anyway. This is just for people 65 and older. Same level of capital gains, so $50,000. So you can see Total income is the same in this situation, but where we start to see differences is that standard deduction. So we did get a little extra there. We were going from $30,000 per year to $31,500. That $1,600 remains the same for each person, or $3,200 for a married filing jointly. But then this other deduction we're losing out. So this was under the old law. If this hadn't passed, we're not getting that bonus $12,000 deduction. So you can see the taxable income has risen a fair amount from $88,550 with the passage of this bill to $102,050. And what that means in terms of taxes is we can go down here and compare now. So you're paying almost a little more than $3,500, almost $3,600 in taxes, compared to with the passage of this legislation, you are gonna pay $1,355. So that's a pretty meaningful difference. Almost a little over $2,000 of difference in tax for this specific couple under this income scenario. But let's take a look at what this means in other scenarios. So let's add a scenario to this. So I'm going to scroll up here. In this situation, I'm going to say that they have lower income. So we're going to go with $2,000 of taxable interest still. We're still going to have qualified dividends and total dividends. But you'll see here, let's say that they were able to defer their pension, and that made good sense in this situation. So they're not claiming their pension yet, but they do have the same amount of Social Security benefits. And then also, let's say they had cash at the bank that they're willing to use as opposed to recognizing capital gains in their portfolio. So we're going to assume that $50,000 goes away just to see the sensitivity of what happens to the taxation here if they were to have lower income. So I will say in this situation, if we scroll down first, we'll see that the taxable Social Security amount is much less. So it was 85% taxable. If we go to this scenario, it's not necessarily fully taxable. It's only being partially taxed in that situation because it's low enough. That's, again, not a feature of this bill that just passed. That's just the taxability of Social Security and how it's taxed in these situations. That if you have low enough income, it's not fully taxable, and it could potentially be 0% taxable if your income was low enough. So if we scroll down, we'll see that this is much lower now, almost $38,000 worth of income. And again, that's because we're only adding up this $10,000, the taxable portion of Social Security, plus these dividends and taxable interest in that case. They're not getting fully taxed on this $45,000 worth of benefits. And then if we assume that standard deduction, and then that bonus deduction that we just talked about, that $6,000 per person, you'll see that they aren't paying any tax. Because their deductions are actually higher than their gross income, there's a missed opportunity. And what I mean by that is they could actually recognize more income and not pay additional taxes. This is looking at the next $1,000 of ordinary income. So they could recognize about $18,000 worth of ordinary income and pay no more in taxes there before you can see it start to spike up here. On the capital gains front, if they wanted to maybe diversify a portfolio in a brokerage account or just recognize income to get stuff from the portfolio or to raise their cost basis, such as capital gain harvesting as an example, they could recognize about $78,000 worth of additional capital gains and pay no taxes on that. So they wouldn't actually want to sit there and just let that year go by. I know it sounds good that like, hey, they're not paying any money in taxes, but there's a missed opportunity. So I just wanted to point that out as we go along to show you what happens there. So in a low income situation, you're going to pay no tax on that, and that bonus deduction does help them. Let's take that a step further and say that they don't have any Social Security. So let's go back to the original analysis where you get $2,000 of taxable interest, $25,000 of qualified dividends, and let's increase their IRA distributions for $45,000. Let's say they want to take money from that side of the portfolio for whatever reason. They have their pension again of $20,000, but they haven't claimed Social Security benefits, and they're also going to recognize some capital gains. How does that affect the taxation here? Well, if we scroll down here, we can see that their adjusted gross income is $142,000. They're going to get that same $34,700 that we had from that original analysis. They are also going to get that $12,000 deduction. They haven't hit the phase out yet because they're at $142,000. That phase out for married filing jointly doesn't start until $150,000 and doesn't fully phase out until $250,000. For single folks, that's $75,000 that it starts to phase out, up to $175,000 until it fully phases out. So this is an example where we're getting kind of to the top of that before it starts to phase out. And you'll see here they still get that full $12,000 deduction, and they're paying about $2,000 in taxes. Let's go a step further. Now let's say that they have even higher income in this situation. So higher income this next year. And we'll scroll back to the top to see what that looks like. So we've copied over the $2,000 plus the 25 plus the additional 25. They didn't take any IRA distributions in this scenario, but they do have that pension still, and they are collecting Social Security benefits of $45,000 per year. You can see that's going back to being fully taxable at 85%. And then let's say that they recognize $100,000 worth of long-term capital gains. Maybe they want to do some gifting to their children, or they wanted to move houses and they had to free up some income before their current house sells, and they needed some cash from their brokerage account to do that. So you can see their total income in this situation is 185. So we're going above that 150,000, or it starts to phase out for that $12,000 deduction. And we see that happen. We get that same standard deduction we had before, but instead of the full $12,000 they had before, or in that original analysis, they're at $7,770. So it's only a partial deduction if your income gets high enough there. You'll see where their taxable income falls at 142, and they're paying more in taxes. Now, let's go one step further and add our final scenario here as a point of comparison. So we'll label this even higher income, and in this case, we copy over everything. We have the pension, the qualified dividends, the taxable interest, the full $45,000, again, fully taxable for Social Security. But this year that they decided to recognize $200,000 worth of capital gains. They're really moving into a nicer house. They've just sold off part of their portfolio or did something else where they needed to recognize income. And their income pops them above that $250,000 for married filing jointly of that phase out. So they're still getting that full standard deduction that they normally would. But as you can see here, that $12,000 deduction goes away. Again, this isn't tied specifically to Social Security. We've had scenarios here where they're not getting Social Security benefits, but they still get that $12,000 deduction. So I just want to make that distinction because there is some confusion out there in the media and other online comments of how this is actually working. It's just 65 and older, but you can see if you have high enough income, you're not actually getting a benefit in that situation. And we can scroll down and see what they would be owing in taxes. So this is important to keep in mind that this new $6,000 deduction is going to be a benefit to some people. To other people, it's not going to be a benefit. So whether 90% or almost 90% of people end up not paying taxes on their Social Security benefits, it will depend. If you're 62, 63, or 64, you're not going to get that $6,000 deduction. It's only for people 65 and older. And there's situations where you do want to wait and defer Social Security benefits, not necessarily for these tax reasons, but just to optimize benefits over your lifetime. So I hope this has helped shine some clarity on how your tax situation could change. And this is, again, why it's important to run a tax projection each year to see where you'll fall. And if there are tax planning opportunities like the 0% capital gains harvesting or doing Roth conversions, I've talked in my previous video that that's not necessarily dead. That's something that you still want to be analyzing year to year. If you're curious how this new bill could affect your taxation, click the link in the description down below and schedule time with me. I'd be happy to talk about what I offer people and how this could affect you. Thanks again for watching. Remember to click that like button and subscribe to the channel to be notified of future videos. Enjoy.